Let's finish with a couple of recommendations here that you're looking at. I mean, people's got their own circumstances, but this is just such a fabulous way to get a broad diversification, in the broad real estate sector, up and down. But give me an example of something that has really caught your eye now. It may be a little easier to purchase, after the kinds of sort of declines we've seen in the markets for this space. One of the most fascinating people I've ever met in the field of investment real estate is Jeff Olin, Vision Capital. He and his partners there and his team have had an exceptional track record. I mean, it's incredible. I think they've never failed to not make on average 10.5%. They're up 420%, since inception. Jeff joins me now. Jeff, I've got to start with, you being able to maintain that average, for 2024. And the reason I'm saying that is, it was a brutal time in the last several months, especially in the real estate investment trust sector. Now, you guys invest in the market. I should have said that up front. You buy undervalued stocks in the real estate sector, of course. Obviously sell them when they've come back. You look for takeover candidates and all that in the market. Well, the market punished REITs. So to be honest, I was surprised you guys were able to maintain a positive, return in that period, let alone maintaining that average of 10.5%.
Yeah, it certainly was a challenging context. Things look pretty good in REIT land coming into the third quarter. Beginning of 2024, we had no idea whether the Fed was going to cut rates twice, three times. Was it going to be 24 or 25? But we were confident that the Fed wasn't going to increase rates. And historically, when you've seen Fed tightening peak, the following 2 years, REITs were up like 19.7%, and the following 3 years up 30%. So third quarter looked pretty good. Fed tightening peak, they started to cut rates. And then we had a confluence of events. In the US, of course, you had Donald Trump elected decisively, tariffs to concerns about inflation. So the yield in the 10 US bond spiked up significantly. In Canada in October, you had the announcement from the Trudeau government about the cuts of immigration, challenging our population growth, the concerns over those U.S. tariffs, the decline in the Canadian dollar. And then in Europe, you had the budget deficits in the U.K., which led to the 10-year gilt, the equivalent of the bond, treasury bond, going to the highest yield since 2008. So in that context, REITs were down 15% in Canada. So, this comes back to our strategy. How did we maintain ability to protect capital? And the answer to your question is, one, we don't buy indices. We're not long only. And our mantra is we seek to buy real estate cheaper in the stock market than one can in the property market. So we look at the underlying net asset value of what that property is worth and to compare it what it's trading at. One of my former clients used to say, he was from Newfoundland, so pardon my twang, it's hard to fall into bed when you're sleeping on the floor by. And so, so price is correct and you're trading at bigger discounts, and we have that compelling situation today. The other factor, of course, is we can be short. So one of the investing theses is buy low, sell high. Well, being short is the opposite. If you can sell overvalued or sectors where the fundamentals are more challenging, that helps to hedge your risk. And clearly in the fourth quarter, our short positions contribute significantly to help protect capital.
And that's, again, alluding to my question, is such an important key component. I've always liked that about Vision Capital. I think you need to go long short, in the market and look at the volatility. My goodness, you can make a lot of money in both directions. But let me come to I love that analogy, by the way. I'll give credit to the Newfoundlander for that one. But come on, doesn't it sort of make you sort of rub your hands together thinking there's some opportunity out there, because we've had this big decline in REITs?
Yeah, exactly. What is very interesting and what makes the opportunity compelling today is in the fourth quarter, real estate fundamentals improved. Vacancy rates came down. demand was still strong. Because of the big spike in interest rates in the prior 3 years, new construction has fallen off a cliff. So you have improving fundamentals. And even though the yield in 10 years bond went up, you actually had sectors where cap rates, the unlevered return, which has some short term, and I want to come back to this, short term correlation to bond yields, they actually declined, notwithstanding yields went up, and credit spreads came in significantly. And so the real estate fundamentals improved in the context of global concerns. And so now we have, in Canada, I think the number is 24% discount of the implied valuation of REITs relative to the valuation of their properties.
Well, and again, that's what makes your approach, I think, very unique. The way since 2008, I think off the top of my head, you guys have been looking in the market, looking for stuff because the market, makes pricing mistakes. That's the opportunity in the market. That's why it's important also to go short sometimes because we way overvalue stuff or we way undervalue stuff. And you've done that, obviously very successfully. I'll let people know because people know, I always say this, Jeff, I like results. Do you know what I mean? This is a business of results. And I wish our politicians would understand that. I could sit them all down and explain, when GDP per capita goes down 97 quarters in a row, that's not a good result. But you guys have had that result. You're up 420% since inception there, but it's the consistency too. And again, because you're allowed to go short and long. So when you look at this kind of an environment, give me one example, and we'll come back to some others, but give me one example of something that has interested you right now, with Vision Capital.
Yeah, I mean, we like the grocery anchored, necessity based retail space. We do like it in both the United States and Canada. We like it a lot better in Canada because there's less retail square footage per capita in Canada. Vacancy rates are lower. We've had very, very little supply. So it's necessity based. It's grocery anchored, and the other tenants are, they're shoe repair, they're nail salons. You can't get your teeth cleaned online. You can't get your shoes repaired online. So they're not as susceptible to e-commerce. Rent growth is compelling. It's stable, it's defensive, and yet there's growth. And some of the names we like actually have significant upside because of the location of their properties, and they have significant density to build apartments in the middle of these urban locations in Toronto, Montreal, Vancouver, Ottawa, Calgary, Edmonton. So that's one area where it looks more compelling now. It looked pretty good at the end of the third quarter, but because valuations have come down. I mean, the other thing to your first question and tying your first and second question together, our biggest attribution to our fund on the long side last year was in the data center space. You can't be in that business as a individual, even large corporation. It's interesting. You pick up the newspaper every morning. There's another pension fund institution says, we got to be in AI. We got to be in data centers. And we say, how? How exactly are you planning to do that? You don't have any development capability. You don't have the global technology relationships. And the only way you're going to be able to do that is to joint venture with one of the incumbent, very large, high quality, publicly traded. There's a couple of large, Blackstone has a private platform, but it's primarily the public platforms that are benefiting from this space. So that's something that's really misunderstood, is the breadth and depth of diversity of opportunities in public markets in the space.
But it's also a reflection. Again, you guys do a lot of things, but you look different geographics. Obviously, you look different sectors. Industrial, residential. The list is a long one, but this is where it's so challenging for an individual to do it themselves. You need a level of expertise, and I love your thought process and how you've explained that. When you look at something like a grocery anchor there, I mean, that's one thing I think we're going to still be eating no matter what other changes come, and as you say, other businesses that aren't subject to getting destroyed by e-commerce or internationally or what have you. The competitive space is much more controllable. So I love the thought process, but I want to make sure people know you're looking across the board, across North America, different sectors. You've been in, one of the things you've done very well for Vision Cap and people who've been listening to you through Money Talks is when you went and got into warehousing early, looking at the e-commerce explosion. So I just want to make sure people know it's not just residential, or as you've just explained, looking at sort of a shopping center space, with a grocery anchor. Yeah, it's this is why you need people with expertise, I guess, is that long-winded way of saying that, Jeff. But yeah, you need people who are spending full time on it.
We've shifted around, but we continue to like the industrial space. The sector got completely crushed last year. There was a lot of new supply, but we've shifted. What we like today is the small bay industrial, not the big box regional distribution centers. There was a lot of new supply in that area. That's what the developers have been building. Nobody builds the 24-foot clear height inner city real estate that's so-called obsolete. But that's the stuff that's getting the highest rent growth because it's close to consumers benefiting from the last mile distribution in e-commerce, and there's no new supply, and the vacancy rate, it's de minimis really in terms of that space. So we focused on REITs in Canada. Dream Industrial REIT is one name. Even in the US, where we reduced our exposure, a name like East Group, which is in small bay Sunbelt, having growth. So we still like the space. We like it in Europe as well, which is really lagged, got really hit when that UK gilt, the bond, went up. So that continues to be an area of favor for us.
Let's finish with a couple of recommendations here that you're looking at. I mean, people's got their own circumstances, but this is just such a fabulous way to get a broad diversification, in the broad real estate sector, up and down. But give me an example of something that has really caught your eye now. It may be a little easier to purchase, after the kinds of sort of declines we've seen in the markets for this space.
Let's go over what we said. I mean, we said we like grocery store anchored. We like First Capital REIT. It continues to be the largest holding in our fund. We said publicly at an investment conference just over a year ago, it was the highest quality grocery anchored portfolio in the world. That's a big, bold statement, even for Vision. It's like a $3.5 billion market cap. It has a nice 5% yield, and we think it's trading at a 25% discount to the value of the real estate. Industrial, I mentioned Dream Industrial REIT. That has also almost a 6% yield, $3.5 billion. We think it's trading at a 30% discount to the value of the real estate. In the UK, we like Tritax, big box, listed on the London Stock Exchange. Again, 5% yield for European REIT, 30% discount to value, really well positioned. You mentioned residential. We're avoiding apartments except for Boardwalk REIT, which has focus in Alberta and Saskatchewan, where there's no rent controls. It has enjoying the biggest population growth in Canada. That stock was $91 earlier last year. You can buy that stock today, $60. And the value of property transactions are actually going up. If you look at the price per square foot of where trades are happening in Calgary and Edmonton apartments, they're actually gone up. Boardwalk's on sale. And we like Sun Communities. Sun Communities is in manufactured housing communities, probably the best property class in the last 40 years. Very stable, very defensive. They have 116,000 manufactured housing community sites, 59,000 RV sites, 48,000 marina slips. That stock traded for 10 years between 2011 and 2021 at a 24% premium to net asset value. We love the fundamentals, but we didn't own it because we want to buy at a discount. We bought that stock over the last year at a 10 to 20% discount to net asset value. They've never had 12 months of declining NOI. So those are some good names. Sun is SUI, is their symbol for your audience. And I guess the last area is seniors housing. Everybody understands the demographics, but there's some great operators in public markets. Chartwell in Canada, biggest name in the space. is a great name. CSH is its symbol, 4% yield, less discount to NAV because it's a high growth name. And Sienna REIT, which has a nice 6% yield to it. SIA is its symbol, trading at probably a 16 to 20% discount to the value of the underlying real estate. So good smattering, different sectors, diversified approach. That's sort of what we're doing on the long side.
Well, and as I say, the record speaks for itself, but I'm talking about the Vision Alternative Income Fund, which you can just buy, no documentation, none of that. I mean, you just click, you buy it. There's no subscription documents when you do that. But, what I think is fascinating is the way you guys have done, proven track record, but so much work. I love to hear that discount value. You can't do that in the market. If I've got my house for sale, I'm not all of a sudden saying, how about I give it to you at a 30% discount? That's why the stock market approach it's both unique, but it's fascinating because you get the kind of discounts you just alluded to there.
Yeah, I mean, you could skip a half-hour pitch on Vision if you understand why one category of our investors invest with us. And no disrespect to our pension funds and institutions, but if you look at real estate families that have made all their money from multi-generations investing in properties, and we have over 45 of these iconic families, why are they investing in a real estate fund? If you ask them why, because we're curious, you get one or two or four answers that explain what we do. The first you touched on. These guys love the asset class, but it gives diversification to the family by property type and by geographic region. Yep. Secondly, they like buying anything at a discount, but real estate at a discount, this is compelling. They can't do that in the property market in a bidding war that Colliers or CBRE is hosting. Number three, these guys are smart. When the fundamentals are negative or deteriorating or valuations are too high, they can't do anything about that in the property market. They like to use their expertise to make money in declining market by being able to be short. And lastly, of course, and this has been a huge issue globally in all asset classes the last 2 years, liquidity. Yeah. You don't have much liquidity in your property portfolio. So to create diversification for their family by property type and geographic region and have liquidity is something they don't have in the property portfolio. And we love them because they're strategic. We want to know what's going on in property type or geographic region of this continent. We know who to call. They're friendly, aligned, and constructive.
Yeah. Great stuff as usual, Jeff. And again, go to Vision Cap. We're talking about, again, for individuals, it's very easy. The Vision Alternative Income Fund. But as usual, what a pleasure to get a chance to chat, Jeff.
Nice to see you. Be well and enjoy your show.